The following presentation is going to be a training session for a model called H2FAST. My name is Michael Penev, or Misho. This model has been developed with funding by the Department of Energy, the Fuel Cell Technologies Office, and most recent funding has been provided through Neha Rastagi. The model was first published in 2015 and has been in use for various applications. It was initially developed in collaboration with a number of partners, such as Hydrogen Fuel Cell Partnership. They used to be called California Fuel Cell Partnership. H2USA, which is a consortium of many industry and public entities. We also have worked with California Energy Commission, Air Resources Board. The model is very rigorously reviewed by a number of experts in the field, both in laboratory level, as well as it has had input from folks out of the debt side of investment, as well as from equity side. It has features and rigorous capabilities that are programmed in to address the way of viewing different types of business cases and investments from those sectors. The model purpose is to provide a flexible analysis that is tailored towards a variety of different systems. It is fairly agnostic in terms of what it's actually computing. Typically, if you have a business case that provides either a commodity, it converts different feedstocks into something that is a higher value product. The user would have to identify what is that commodity, then also identify what capital costs, operating expensive, any incentives that are available. They can provide capital structure. The model is able to then compute financial performance, incentive impact. It has built-in risk analysis. In terms of what types of systems we have used this for in the past, we have initially developed the model to be able to handle retail sale of hydrogen for hydrogen infrastructure for refueling. But we have also most recently used it for converting the H2A models, which are for hydrogen production, into a framework that is much more user-friendly. It's called the H2A Lite model, and it is able to analyze things like electrolysis, fossil-based hydrogen production with and without CCS, carbon capture and sequestration, biomass, and other hydrogen production pathways. The model can also be used for analyzing things that have capital and operating expenses. For example, if you have delivery components, pipelines, or compressors, or truck operations, you can definitely analyze those. We have used the model for ammonia production, for methane pyrolysis, EV charging. There is a version of the model, it's called H2FAST, and it has detailed handling of things like rate structures for demand charges for EV equipment owners and operators. Seasonal energy storage is another application. Spin-off of this model is called StoreFast, and it does utility scale energy storage analysis. We have used the model for fleet operation. If you have somebody delivering so many ton miles of freight, a service that can be modeled with this framework. Combined heat and power is another example. And again, we've used this model for many different types of systems. Different types of model users, systems operators, government policymakers, equity, debt investors, strategic investors. There is a method of doing take or pay contracts that can address, third-party interests into a business case. And of course, equipment manufacturers, OEMs for car manufacturers, they want to understand, for example, what does a business case look like for downstream use of their vehicles. And of course, we've had many people download and use the model from academic and national laboratories. The model framework converts engineering input into a framework of generally accepted accounting principles. It provides detailed articulation of standard financial statements which is income statements where we articulate revenues, expenses, taxation. Also, we have cash flow statements, which show what is the cash position, what are the expenditures and other financial transactions of the business case. We have a balance sheet, which provides assets, liabilities, and equity positions. One thing to point out is that while the model is designed for GAAP, it is also capable of doing analysis in terms of IFRS, which is International Financial Reporting Standards, which is a function of what inputs do you provide. For IFRS, you cannot have, for example, accelerated depreciation. You have to treat non-depreciable assets in a specific way. If you're interested in doing IFRS analysis, that is possible within this model as well. One key item that I want to point out is that in the balance sheet, we treat cash generated by the project operation. We call it dividends, but it doesn't necessarily have to be dividends that are issued to shareholders. There are too many ways to treat them, whether a company wants to treat them as retained earnings for reinvestment purposes, or if they want to accumulate them for refurbishments of the equipment, or if they want to use debt investing as a bond, such that the principal of debt can be repaid at the end of the project. We don't get into that. There are too many ways of treating retained earnings that are typically subject to board of director decisions, and we just say how much cash is generated by a project that is in excess of some liquidity or debt reserve requirement. The model has two modes of operation in general. One is it can take a price for the primary commodity and then determine what's the financial performance. So, for example, if you have a market where hydrogen can be purchased, the market can bear, let's say, $4 per kilogram, or ammonia can be sold for $2,000 per ton, or whatever the primary commodity is. The model can be told, I want a certain price profile for my primary commodity, and then based off of that, it will compute what the financial performance is in terms of net present value of the project, or the internal rate of return, or profitability index. It will report those values. The other mode of operation is that the project can set its own price in order to meet the financial performance that is specified in terms of return on equity. So, for example, if you want 10% return on after-tax equity, you can tell the model, tell me what the price should be in order to achieve that financial performance. So in that perspective, we have a price setting version of the model where you provide your financial performance targets, and the model returns the price that you should charge in order to pay for all your operating expenses as well as all your financing expenses. The model has 4 tabs. The first tab, description, it gives you what is the model, a little bit about version history. We've been using this model for 7 years now, and we've had a few updates in between. There is a user agreement. Interface tab is the main point of controlling the model. It has almost all the user inputs for modifying different scenarios or doing risk analysis. You have your graphical outputs there. There is also another place where the user can provide inputs. That is the overrides tab. That is for power users that might want to really customize things like prices, where you want to have price profiles. So, for example, if you want annual energy outlook to provide cost of electricity over time instead of giving it a fixed price and an escalation rate, you would use the overrides tab to provide more nuanced analysis inputs. Lastly, we have the reports table tab, where we have some general information for feedstock escalations or the price profile of feedstocks, as well as all the financial statements for the analysis period. Your income statements, cash flow statements, balance sheets, those are reported there. One thing that I want to point out now, in case I forget later, the analysis period actually starts 1 year before the project onset, and that has to do with a convention that whenever you report a financial performance, it is as of December 31st. And when modeling investments, that typically occurs the year prior, December 31st, is treated as January 1st of the analysis year. So for example, if you want to start a project in 2025, financing is going to be actually obtained on December 31st of 2024. And it's going to be able to simulate having that cash on hand or that financing available to you throughout the full year of 2025. We're going to go into a deeper dive interface tab, which is the main interface for the model. And I'm going to go over the different portions of the model. When you first open it, it's going to be a little bit overwhelming, but hopefully some of the organization is going to make more sense as I go over it. So the first portion to be mindful of is section 1 here. In this section, whatever is populated is what the model uses at any given time. In this section, we have specifications for what is the primary commodity. Are you producing cement? Are you producing ammonia? Are you producing, whatever it is, you will specify that. You would specify as well sales. What year is the project going to be financed? How long does it take to have that project constructed? Are you going to ramp up demand, or is it going to start operating at full capacity? That's where you would provide that input. And also this is where you would specify, are you going to have a price setter mode where the model is going to tell you what you need to charge for the commodity, or are you going to be using a price taker mode and comply to larger market forces for that commodity? We have incentive specification, and when I go over these are actually correspond to headers within this section of the model. You can collapse them. They're little clicky buttons that I'll show you later, where you can collapse and basically go into each of the sections and provide inputs. So incentive specifications are in here. You can do a couple of production incentives, either as an income or as a tax credit. You can have also capital incentives. You can have other sources of income, as well as take or pay contracts. There is a CapEx section that is broken down up to 10 items. If you have 100 items of CapEx, you might want to group them by category. Each of the CapEx items can be depreciated by different amounts. So if you have items that have different type of allowable depreciation, you might want to group them by depreciation. There is a section for feedstock and variable operating expenses. There are two sections for feedstock. One is for the quantity that is produced. So physically, are you using so many gallons of water per unit of primary commodity? In this section, you'll provide the physical amount of a commodity use. Also, if you have other variable operating expenses, you will just say, I have a unit of 1. And later on, you're going to say, well, per ton of ammonia, what does that cost in terms of variable operating expenses? And again, I'll demonstrate that later in this presentation. Similarly to feedstock, we have a section for physical co-product generation. This could be things like if you're producing graphitic carbon as a primary commodity, but you have co-product of hydrogen, you would say per ton of graphitic carbon, how much hydrogen you're producing, or any other value stream. If you're doing energy storage, is there an amount of revenue that you're going to generate for things like ancillary services? That's where you would identify that, yes, you're going to produce ancillary services, and then later on you're going to say, well, how much is that valued? Subsequent section, we have feedstock, waste streams, what is the cost of those units that were produced, and the same thing for co-products, what is the price of the various value products that are produced by a hub or by any type of a project that you're looking to analyze. There is a section for other operating expenses. This is where you would have property tax, insurance, credit card fees if you're operating on a retail level. If there is sales tax, any other fixed operating expenses you're going to specify in this section. And lastly, we have a section for financing, which covers capital structure. So how is the project financed? What is the taxation? What is the liquidity requirement or debt reserve requirement? Do you want to have 1 month worth of operating expenses so you can have liquidity to operate the business, or a debt investor wants to have 12 months of operating expenses? So that's where you would specify your capital structure, taxation, and liquidity requirements. The next section is pretty straightforward. Section 2 is where we provide the overall metrics. Things like internal rate of return. This is basically the IRR with an equity perspective. How much equity was put in up front, and what is the subsequent cash flow to equity, and we compute IRR with it. One note is that the IRR function is actually fairly unstable whenever you have complex cash flow. By complex cash flow, that means that if in the future the cash flow goes positive, negative, you can have multiple solutions for IRR that are almost equally valid, and it's not always clear which solution is correct. So from that point of view, we also provide a more stable mathematical representation of financial performance. Not everybody is familiar with it. Typically, it's called the profitability index, and that's value of future cash flows divided by the upfront investment. And it's the value of future cash flows discounted by the return of equity. So from that point of view, if the profitability index is greater than 1, you're more than achieving your desired return on equity. If the profitability index is less than 1, you're coming short on the performance on equity that you have specified. Investor payback, this gives you basically how many years does it take for the investment to be paid back. This parameter here was requested by the folks on the debt side. They want to know at what point earnings before interest, tax, and depreciation would be positive. NPV of a project is relative to the discount rate on equity. If you're doing a price setter type of a model, NPV should always be 0. For that matter, profitability index should be 1, and IRR should be the rate of return that is necessary. If you're doing a model where you're taking market price for a commodity, NPV should be something else, not 0. And then your IRR should deviate positive or negative relative to your objective financial performance, and then profitability index is going to be something other than 1. Price to achieve target IRR. This is where the model would tell you what you need to charge to achieve exactly the equity performance that you're looking for. And lastly, we recently added a project level IRR. This is IRR in terms of, in absence of finance, what is the project level performance. And this IRR here on a project level is going to have much higher number than the equity IRR because it doesn't cover interest and taxation and financing aspects that's for the equity level of IRR. There is a visualization portion that is grouped on the left side of the screen. In this section, you're going to find time series data. There is a drop-down menu right under the primary results where you can select any parameter from income statement or the cash flow or the balance sheet. There's some ratio analysis that are available as well, but you can basically use either a drop-down menu to update what is being displayed, or you're going to see blue buttons that say plot. We've picked out, if you're looking at CapEx, that you can click on this and see how CapEx is expanded during the construction period if you've provided a schedule, or if you want to look at price profile for commodity feedstock, you can click on that and the chart would automatically update. We have a cost breakdown. Basically, we're looking at all the cash flows and we're normalizing it on per unit of primary commodity of a hub or a project. And in this way, you can see what things are providing either a lot of value in terms of either financing cash flow or sales revenue. You can see that positive cash flows normalized, or you can see operating expenses, which ones are more important, or financing expenses. You can see which things are important and move the needle, and which things are less important. So you have positive cash flows, negative cash flows being articulated on per unit commodity. The next graphic that is available is cost of goods sold. This is strictly operating expenses and depreciation normalized on per unit output of each year. In this particular example that I'm going to, again, take a deeper dive later, you'll see that depreciation is a prominent feature of the cost of goods sold early on, because we're using, in this case, accelerated depreciation. And then you can see how other things stack up in terms of operating expenses per unit output. I'm going to skip to the last chart here that's available. This is a normalized cost per unit output. So if you want to see a one-dimensional expression of what does it cost to sell a ton of ammonia or whatever is being analyzed, this will give you a breakdown. And now to come back, we have a couple of charts here. They're related to risk analysis. If you have any parameter that is uncertain, the model will do Monte Carlo analysis and provide you distributions of either input parameters for the Monte Carlo or resulting high-level parameters in terms of what's the impact on price, what's the impact on profitability index. You can see what that is in terms of a statistical distribution. Also, there is a chart that gives you a one-dimensional sensitivity for each of the uncertainty parameters, and basically this chart would show you if any given uncertainty parameter is at its limits, what is the impact on the objective that you're looking at. And you can switch that to price of hydrogen or price of ammonia and how it's sensitive to things like, let's say, interest rate or capex uncertainty. It will give you the sensitivity of any of those parameters. You can switch it to MPV, and basically will give you one parameter sensitivity. Next is scenario differentiation section. Let's say you have a primary scenario and you want to also analyze how that scenario might be sensitive to different capex or different level of incentives. You would populate your main scenario. You would click the circle right next to that parameter, and this section here, which I'll describe next, is going to open up. Typically, this section here for scenarios is hidden unless a user specifies that a particular parameter is going to be a differentiator for scenarios. Once you select a parameter, it would highlight scenario inputs for that parameter, and then the user can populate the different scenarios that they would like to analyze for their project. So if you've selected a scenario differentiator, you'll see this section. You can have up to 300 different scenarios. On the very top, you can select, do I want to have 5 different scenarios that they want to analyze, or 2, and it will cut down the number of columns that are displayed. Name the scenarios. So for example, you can say a large electrolyzer system, a small electrolyzer, and a medium electrolyzer system, and then you'll provide the capex and the capacity for the different scenarios, assuming that those are the scenario differentiators. The model is set up to populate the differentiating parameters into the model input, and you can select which scenario is being analyzed by clicking on 2 macro buttons. They're set up with little arrows. If you click to the right, the next scenario to the right is highlighted. If you click to the left, scenario to the left is highlighted. And this way you can switch between scenarios, and all the graphics are going to update, as well as any report tables. They're going to reflect whichever scenario you have selected. In section 6, we have results for each of the scenarios. So key results for a scenario are being recorded as you sweep through different scenarios. One thing to note here is that the data is not recorded until you hover away from that scenario. So if you, let's say, change input parameters for a particular scenario, this data here is going to be static until you highlight that scenario and it's pushed through the model so that the results can be recorded. If you're doing something fairly complex like supply chain analysis, it's going to matter in which order you do the scenario refreshing. So for example, if in the first analysis slot you're doing production, then you're doing transmission, and then you're doing distribution and dispensing, for example, you would want to update them in that order, as the prices that are resulting from one are going to inform the next level of supply chain. Lastly, section 7 populates whenever you click a macro button that says risk analysis on off. In order to reduce clutter, this section is also hidden until the user decides that certain parameters have uncertainty to them and they would like to populate a range of inputs rather than point estimates. Certain parameters might have high level of certainty and you might not want to clutter your analysis with providing spread for them, but certain parameters might have high level of uncertainty and also high level of impact on your final results. So those you might want to be able to specify a range for. This button up here, if you click risk analysis on off, it will reveal inputs for almost any parameter. You can provide a minus percentage to plus percentage relative to the most likely value that you've provided into your primary example. There is also a button that says evaluate uncertainty. When you click that, depending on the speed of your computer, it might take anywhere from a couple of minutes to, if you have a lot of Excel files open, it might take longer, or if you're running on a slow machine, it might take longer. For my laptop, it takes about 2 minutes to run 1,000 scenarios where Monte Carlo analysis is going to roll the dice on any of the input parameters and run the financials for that scenario and provide distribution of outcomes relative to the distribution of inputs. Once the analysis is performed, you'll see that the statistical distribution tables are going to be updated, as well as tornado chart is going to be updated. Right now, it actually says that they are not updated. You'll see a little warning message. If you've modified the inputs to the statistical analysis, to the risk analysis, you'll get a warning message that you need to rerun the model in order for these to be updated. So when you run this, you'll see that these charts are not going to have any warning messages on them. In this case, they're in red and yellow. And by clicking the different buttons next to the risk analysis parameters, this chart here is going to be updatable to the distribution that was actually used for any of the input parameters. And if you select any of the outputs, it's going to update the chart to provide the distribution of the output parameters. So for example, if you want to see what your MPV distribution looks like, you would click here and you'll get your MPV distribution relative to all the uncertainty parameters that you're looking at. If you click MPV, it's going to show you also what is the sensitivity for each of the parameters if it was at the endpoints of the distribution range that was provided. Similarly, if you click price of commodity, it's going to modify these charts to show you the statistical distribution of the price as well as the sensitivity of the price. One thing to point out is if you're doing price taker model, no matter what, the price is going to be whatever the market demands. So if you click price, you're going to have no distribution here because no matter what, the model is going to reflect a static price that is paid. Next, I'm going to describe what goes on in the overrides tab. You have two general sections. One is to allow you to customize profile over time in terms of calendar year. For example, if you want to use annual energy outlook for price projection, you would provide that price projection here. One thing to note is that any inputs that you provide here have to be in nominal dollars. In general, finance is done in nominal dollars basis. If you put in real dollars here, it would effectively underestimate the cost or the expense as real dollars actually, or discount the value of future dollars. AEO, for example, does report both nominal or real dollars. Make sure to use the nominal dollar projections for anything that you populate in this section. As soon as there is any input in any of these rows, it's going to say here that that input is being overridden. What that means is that if you provide a price and escalation in the input sheet for your commodity, if you come in here and provide a sales price that has a more specific profile over time, that's going to override inputs from the input sheet. If you want to put in information, but then later you change your mind and you don't want to have override information, make sure to completely erase that whole row so that it's not being overridden in the input sheet. If you just zero out the information in here, the model is going to still see that there are values in there. They happen to be zeros, and it's going to treat them as zeros and still going to override anything in the input sheet. In order to allow the input sheet to provide financial information for the model, you will need to completely erase any inputs in any given row. The second section of the Overrides tab is parameters that vary on an analysis year basis. These are things like efficiency, or how much feedstock are you consuming per unit input. What is the utilization of the equipment year over year? Do you have any capital expenditures that are associated with any of the CapEx line items? So for example, if you have a refurbishment event, you would specify that 30% of my compressor gets expanded every 5 years of operation. And this is where you would specify those refurbishments or any other capital expenditures or anything else that is related to year of operation and not related to calendar year. The model is going to line those up internally, but this is where you would specify things that are done based off of year of operation rather than based off of calendar year. A couple of tabs I'm not going to belabor is a description tab, as well as a reports table tab. There are no user inputs that are required for those tabs. So from that point of view, we can jump into a couple of examples of how to use the model. When you download the model, the version is a refueling station that is, we used very, very round numbers for it, just to give an idea of how to model a hydrogen refueling station. Very shortly, we're going to have a model where we have ammonia set up as an example. So you can download that version if you want to have a different example of how to use the model. For the next demonstration of the model, I'm going to show how to use as a basis the fueling example, and I'm going to convert it to something else. So if we zoom out, one thing we'll notice is that you cannot see any of the risk analysis parameters. You can also not see any of the scenario portions of the model. Those are hidden until they're activated. Here you can see that we have a drop-down menu if you want the model to plot any parameter. Some of them obviously are going to be zero over time, but you can see that there is a drop-down menu that lets you update this chart up here, so that you can look at anything from gross margin, cumulative cash flow, investor cash flow year by year. You can see all the parameters that are kind of in general section. There is all the values that might be relevant from the income statement are going to be, they can be looked up, as well as we have cash flow statement parameters, and then you have balance sheet parameters and some ratio analysis at the very end. So those are all selectable from here. In addition, there are little plot buttons where relevant parameters can be displayed. So for example, if we want to look at the price of delivered hydrogen, we can either fish for the value through here, or we have guessed what chart might be relevant to this particular input. In this case, you say plot in this case it says delivered LH2 dollars. What is the total dollar amount per year? And you can use these buttons to update which chart you're looking at. So as you're inputting the parameter, you can instantly audit and see if this is matching expectation relative to the input that you're looking for. If we want to turn on risk analysis, we can click the on-off here, and then we can provide that toggles the risk analysis inputs that we'll go over a bit later. And lastly, in terms of interface, if you have any of these parameters that you want to vary as a scenario, let's say that we want to run a scenario as a price taker and one as a price setter, you can say, well, my price, I'm going to set out as a differentiator, and you can type in names for different scenarios and provide values for those parameters, and you can switch between scenarios in order to see the financial performance relative to that input. The model updates live. As you change inputs, it's going to automatically compute. You don't have to tell it to run a macro to calculate MPV to be equal to 0. So for example, I can set the price model. The model in this case is set to take the recommended price for the primary commodity, and whatever is actually put into row 29 here is what the model is going to treat as a price for the commodity. So let's hit plot next to it. You'll see that we start, the price is set to first year price of $6.15, which is the recommended value, and then it's set to escalate at 1.9%, or in this case, it's set to inflation. Anything in yellow cells is user input. It can be left blank if a particular parameter is not relevant. So even though it says inflation here, we can say we want to escalate the price, let's say 3%. You'll see that impact on the price. But basically, you have first year price, $5.95, and then the price is going to escalate over time. If you want de-escalation or reduction of price over time for some reason, you can send minus 10% over time, and then each year cumulatively it's going to cut off 10% of the price of that commodity. In order to escalate with general inflation, you can also say equals inflation, and that's going to line it up with the specified inflation for the model. If you want to switch the model to a price taker, let's say right now it says that hydrogen needs to be sold at $6.15, but the market would only pay $5. You can just overwrite the cell and say 5. And in that case, 5 might be too low of a price in this example. It'll tell you that the net present value of the project is minus $20 million. You probably don't want to do that. But let's say let's try 5.5, or let's try $6. So at $6, IRR is defined. Again, we don't want IRR is an unstable function. Sometimes it will say margin is too low. In that case, IRR actually doesn't give me a valid result. But this function profitability index is more stable. It would actually always give you a value. MPV is also a very stable mathematical expression, so it will always give you a value. But at $6, you'll see that your IRR is 3.7%, so it's probably not a desirable parameter, a price to set. If the market can bear, let's say $10, now you'll see that internal rate of return is higher than the specified in the financial section, and also project level is going to be even higher value. Let's set this model to be a price setter. To do that, we're going to say this cell D29 is going to equal to the break-even price, or we can just point to cell D9. And in that case, the model is going to tell you what the financials would articulation looks like if the project can set its own price. In the report tables, the model can be audited. There are a lot of calculations that are behind the scenes, and we've been asked, like we want to look at what the calculations look like. Honestly, that is not very useful, but the model can be audited here without having to look through very complicated, formulas that are running in the background. So if you have a specific the financials that you're wanting to articulate, it is encouraged to go through the reports table and assure that if you're expecting 10 millions for feedstock and utilities, that's actually you have 10 million here and it's escalating at the correct or the intended rate. Whatever is populated in the primary input to the model, which is this section here, is going to be articulated as report in the report tables. So with that said, let's change this up. I'm going to pretend that instead of a hydrogen fueling example, we have something that is an electrolyzer. Electrolyzer is still going to produce hydrogen in kilograms per day. If you have a different commodity in the commodity section, you can change that to be, let's say, ammonia or steel or ton mile or freight, and you can say it's ton miles per year. Whatever you're interested in. If you're not quite certain what each of the sections are, there is also a help file. You can help toggle. You can click this button up here, and it's going to give you a reminder of what are the individual sections. For the input sheet, it will have descriptions. You'll also have descriptions for any of the fields that might be relevant for any analysis. There is also additional help or clarification for different parameters. If you want to look at what's actually meant by any input parameter, you can click on row headings and it will give you a description of what's in those parameters, what is the expectation. So let's hide this again by toggling the help button. It'll make all these menus go away. The section headings are always available. So as you're populating inputs, that you can click and see a little bit more descriptive text. Typically, you want to keep titles short, but also you want to not have ambiguity, and we give a interpretation of what's actually meant by each of the headings. Each of the sections is collapsible. There are little buttons. When you collapse them, you're not going to lose any data. Anything that's data that was there before is going to remain there. The same is true if you specify a parameter as an input, as a scenario input. If you provide different levels of input for different parameters, but then you decide that that's not a parameter that you want to differentiate. If you unselect that, it will remember what the input was prior to toggling that as an input parameter or not an input parameter. So let's collapse all input sections so we can focus on each one at a time and to reduce clutter. So we'll collapse all the sections and we'll go one by one and provide inputs for an electrolysis system. So the first section, primary commodity, it will still be hydrogen. We'll still measure it in kilograms. The nameplate capacity is going to be expressed in units of per day. So, and you'll see the nameplate capacity, you'll see that the units are correct. Just as a demonstration, you can say, well, I want to know what to charge. Let's say you have an example where you want to compute dollars per bushel, and your primary commodity is bushels of something. You can say, wheat, and I'm going to say bushel, and let's say it's bushel per year. You can select, you confirm here that the nameplate capacity, or the farm production rate is going to be computed in bushels per year. But in this case, we want to say our primary commodity, or what we're actually producing, is going to be hydrogen. It's going to be in kilograms, and the time basis is going to be per day. And then we can say, well, we want to have, let's say, 50,000 kilograms per day. Nameplate capacity basically means what would you produce if your equipment, or if your product is being, or service is produced around the clock, 24/7. What is the maximum you can theoretically produce? So in this case, we have 50,000 kilograms per day, 365 days per year is what would be the nameplate capacity in terms of how much could you theoretically produce per year if you'd never shut down the system, if everything ran around the clock. So that's the definition of nameplate capacity, and you can, if you click here, it'll roughly say that. Now the next thing we want to specify, so let's collapse this section, is the sales specification. In here we can say, do we want to be a price taker, and say that, let's say that hydrogen has a commodity price that we're interested in, or are we going to say that this is a price setter and the model will tell us what you need to charge in order to achieve the financial performance that you're interested in? We'll leave this as it is. So we'll leave the model in this example as a price setter model. It will set the price of hydrogen for the first year to whatever the model computes in order to achieve the financial performance. And we'll leave the escalation at 1.9%, which is the specified inflation rate. I know that's not today's inflation rate, but this was informed by historical inflation rates that may or may not still be good. Who knows? This is the project initiation. If it says 2021, that means that the project construction starts on January 1st of 2021, and but the financing in the reports table is going to say that financing is obtained in the report year of 2020. Each of these years reports the financial situation of December 31st of that year. So December 31st of 2020 by convention also means January 1st of 2021. So in this year, you'll see that finances are obtained, and also capital expenditure is obligated in January of 2020. But the construction year by the end of 2021 will reflect that that construction is ongoing. Project operational life. This is the operational period after the construction has started. So let's plot. In this case, we'll plot demand ramp up that is specified. You'll see the 2020, nothing happens. This is when financing is obtained. We've specified a construction period of 12 months. Nothing happens in 2021 in terms of sales. Then we can specify demand ramp up period. Let's say in this case we have 2 years of demand ramp up. This is a linear ramp up that's programmed in. You can say, 5 years, and it will take 5 years for the demand to escalate. And then lastly, what is the actual throughput in once the demand is saturated? You rarely achieve 100% throughput. You're going to need time for maintenance cycles. You're going to have some availability factor. In this example, we showed that nameplate capacity is 50,000 kilograms per day, but the long-term utilization yields, we've said that it's 80%. So in that case, in future years, the demand is going to achieve 40,000 kilograms per day and not 50,000 kilograms per day. If we want to simulate the direct coupling to renewables, for example, we can say that we have 40% long-term utilization because you have a synchronous PPA, power purchase agreement, with a wind farm. You can specify the capacity factor, annual average capacity factor that is going to be available for this electrolyzer, and you can verify that that really achieves the capacity factor that you have specified. If you have things like batteries to increase the capacity factor, you would basically say how much on stream, what's the capacity factor given the specific system design that you're using. I'll leave this right now at 47%, which is a decent wind profile capacity factor, which is what I would like to simulate for this particular example. One other thing I want to mention: the installation time can be is done in months. If you would like to have installation time that is not exactly on an year basis, you can say something different than 12 months. You can say 18 months. And one thing that this would propagate through is the first year you're going to have an impact on sales, but also given that you have an integer number of operational years, the last year is going to conclude halfway through the year, since you've had additional half year of construction. And I'll leave this at 36 months, and let's say that you operate the installation for 40 years total, or let's say 30 years of total operation. You'll notice that all the graphics here automatically update, as well as the price reflects updates immediately as you type them in. So if you have 24-month construction, you'll see the price is reflective of that immediately. With length of construction would impact your discounting of future years differently. Also, interest incurred during construction is going to be computed dynamically. So that's the sales section. Incentive specification. There are capital incentives. If this is a tax credit, you would say that this is not taxable. If this is depending on the mechanics of that capital incentive, you would specify it, and again, you can audit if it's reflective of the way that you would like to have that accounted for. You can audit if that is the correct way. In case that is the contribution has a different depreciation schedule from an incentive, you can change that depreciation to be reflective of how that value is going to be depreciated over time. Annual operating incentive, this is treated as an income, or it can be also treated as non-taxable in the financial section, I'll show you there is a way of switching that is either having tax implication or not having a tax implication. This would be basically a fixed incentive, let's say $100,000 per year, or let's go to zero there just for the example's sake. You can click the plot button next to it and you'll see what that represents. That operating incentive is also tied to, here we want it 36 months. It's tied to actual operation. What I just did here was, the incentive is available for the plant, is tied to the plant operation. So if you operate the first year, half of the year, because it took 18 months to construct, that means that incentive is also available half of the first year. But let me put this back to 36 months so that we have round years here. And you'll see that for operating incentives, you can have a flat value, and then you can say, does that increase or decay over time? Let's say that each year we take 10% off of the initial. Hang on a second. You can specify sunset. So, for example, we can say that the incentive is available for 5 years. Just as an example, if you have a state policy or incentive that is available with particular structure, you can say that's available for 5 years, and it's either going to decrease, let's say 10% over time. You can see that in terms of nominal decrease over time, it's going to be decreased over time, or if you want to say it's not decaying but it's being increased by over time, you can say it's negative decay, and you can basically reflect different way of annual operating incentive or direct payment to the to the business case, how that could be modeled. And let's take this out for a minute. We have two types of incentives for per kilogram or per unit of primary commodity. This could be dollars per bushel or dollars per ton of ammonia or dollars per ton mile of freight. You can modify those here. So for example, let's say that we have, since we're modeling a renewable scenario, we can say we have a production tax credit of $3. It's going to be actually a tax credit. And to look at tax credits, we would actually have to look at taxes payable and how those are modeled. So we'll switch it to income taxes payable. So we'll see that if we switch from income to tax credit, we'll see that there is a tax credit that reduces the taxes payable year by year. And we're going to say that it's, let's say, available for 10 years. Or if it's 10 years of actual operation, we'll say 10 years plus the construction period. So it will be available for 13 years in total. That's a way to model which years actually that incentive is going to be available. And again, make sure that this represents what you intend by looking at the sunset. At what year is the tax credit go away, or what year is the how the escalation or de-escalation, if it's inflation corrected, you would put in the inflation rate that you believe is appropriate. And if we switch this to an income, that's going to have less of an impact on the cost of hydrogen. Notice here that if we have tax credit, our break-even price is $3.23, since that income is directly recoverable, if you will. And if we say that the mechanics of that incentive is that it comes in as a line item on the income statement, we can say, well, that's income. It will be treated as a revenue. It's not as effective as an incentive, and I'll have to bump up my price to $3.88. So that selector here allows you to switch between the mechanics of an incentive, be that as a ordinary revenue or income, or if it's going to be a tax credit, which is not going to incur. It's not a taxable event. Basically, it's a direct line between the incentive and the equity performance. So there are two of those. If you have one incentive that has different mechanisms or different sunset periods, you can model that in here. There is also a underutilization support. California has a HRI credit that uses this mechanic. What this does is it provides an income that is on per kilogram capacity. For example, if your capacity is not utilized up to a desired level, let's say it takes 10 years for utilization to achieve a particular capacity level, you can have a support, let's say, for every kilogram of hydrogen that is not sale that is not realized. Let's say that there's an incentive that provides you $1, and it's available for let's say 10 years, and it actually provides support up to 40% utilization. So in this example, if we have $1 of incentive available and it provides support level up to 40% utilization, as soon as the utilization goes over 40%, there is not going to be additional support for that price. So, for example, let's say you have a fueling station and you're relying on that fueling station to achieve 70% utilization before your financial performance is self-sustaining. You can model in a incentive that pays you for all your fixed operating expenses until you achieve that support threshold level. Depending on what mechanics you want to model, you can say, that incentive is available for, let's say, for 5 years, and if you've not achieved your financial performance or utilization within that period, then you have a risk exposure of not being able to offset fixed operating expenses as your utilization keeps climbing. The last incentive, or if there is a revenue stream or that becomes possible that is on dollars per year basis, let's say that you have sale of coffee at a fueling station or whatever the analog might be for your specific analysis example, you can have incidental revenue that is made possible. And you can specify that in here. Let's say per year you can have, $10,000 that might become available. You can specify that in here. If the example happens to be coffee, you might want to also cover the cost of buying coffee in your fixed operating expenses so that it's properly offset with additional expenses that are incurred for realizing this incidental revenue. So we'll zero that out. So that is the incentive specification section. The next section is the capital expenditure, CapEx. And let's collapse this here as well. In this case, we said we have an electrolyzer. In any of the yellow inputs, we can modify them. We can say that we have specifically an electrolyzer. And we can say what the CapEx of that electrolyzer is. I recommend folks actually insert a tab and do process type of analysis and estimation outside of the sheets, just for organization purposes. So let's insert a small tab here and we'll call this process estimation, and we'll do something very high level. We said electrolyzer nameplate capacity, and we'll say that it is we'll just tie it up to this, and we'll say it's equal to 50,000 kilograms per day. Another important parameter for this is going to be what is the electricity consumption. And this is going to be in units of kilowatt hour per kilogram. You can find numbers for this, for example, from a vendor quotes specification sheet. Let's, for example, use 55 kilowatt hours per kilogram. We'll do some process analysis here. We'll say, cost of electrolyzer in dollars per kilowatt is the typical metric that is used for electrolyzers. We'll say, rough number here. We can even call this install cap X is $700 per kilowatt. We would want to estimate the kilowatts of the electrolyzer. Power rating is going to be how much can be produced in 1 hour times the kilo by 24. So in 1 hour, it's going to be able to produce the nameplate capacity divided by 24. And then if we multiply by kilowatt hours per kilogram, this is going to be the kilowatt rating of the electrolyzer. So if you want a quick estimate of the CapEx, in terms of dollars, we can say the kilowatts times the dollars. So rough estimate, this electrolyzer would cost us $80 million. So in the CapEx, we can say electrolyzer equals, in the process estimation, is $80 million. Typically, this type of CapEx, you might be able to do accelerated depreciation. We'll say that it's, accelerated MACRs, or you can do straight line. You can choose the depreciation, but we'll say that it's a 5-year depreciation. And again, don't take my word for it. Check with your tax lawyers or CPAs what the appropriate treatment is for different classes of equipment. We specified installed costs, so we're not going to specify installation here. Non-depreciable assets, this will be things like land, things that are still going to have value after the project is complete. If there is any land, you would say what is the value of that land, and then at the end of the project life, what is the value of that land in terms of nominal dollars. So if the land, let's say, appreciates by 10% annually, you would say that 10% for cumulatively throughout the project life is going to represent the value of that land or non-depreciable asset at the end of the construction period. In the CapEx section, you can also specify a construction profile. Right now, if you just have value of 1 here, that means that financing is going to be obtained in 1 increment, and it's going to be you're going to start paying interest on the entire value of the CapEx from from year one of construction. If you want to spread out that, obligation of when you have the financing on hand, when you're going to, if you want to spread that out over the 3 years that we specified, we can spread that. We can say, for example, instead of one, we can provide an array that is, and you can click on the header here to remind you what the format the model expects. We can say 0.5, so 50% in the first year, 20%, 0.2 the second year, and then the remaining 0.3 the last year, and that will give you a obtaining of capital, as well as having that capital put into the ground on a schedule, rather than to have capital obligated from year one. There is also error checking here. If the model is not getting what it's expected, it'll tell you it's not equal to 1 in this example, or let's say that you put an array that exceeds the construction period. It'll tell you you need to fix this. So let's put it 3 there. So this adds up to 1. The total of the array adds up to 1, and it's also less than the construction period. You can even say 0.5, 0.5. It can be less than the construction period. So it basically says you'll draw out the capital, or you'll have capital on hand for the first 2 years, and then the third year you're going to be commissioning things perhaps. But the capital is going to be, equipment is going to be in the ground, and you're going to be incurring interest for the full amount. The model does assume that debt and equity are none of them, they're synchronous. We don't have leading debt or leading equity. That's a feature that's we don't have in the model. So if you look at the debt financing and the equity financing, they're going to be drawn out at the same rate. So that's the capital section. The next section is feedstock and wastes and variable Opex. And we can delete what was in the default example. We're not going to have delivered liquid hydrogen. This used to be an example for a hydrogen fueling station. Instead, we're going to use things like electricity in units of kilowatt hour. Electrolyzer is obviously going to need some water in units of, let's say, gallons. This section, if you have waste streams, let's say that we have an RO filter reliant system, and not all the water that comes in is going to necessarily turn into hydrogen molecules, but we have some wastewater. We can say wastewater, again, in units of gallons. If you have variable operating expenses, you can say per kilogram variable operating expense, you can say var Opex. There is not, this convention here is a little, the mechanics of this don't necessarily require a unit. You're going to say NA, and you have one unit that we're going to say, what's the cost in a separate section. But for the convention, the mechanics of how to specify variable Opex, you would say just variable Opex unit of 1. In terms of electricity, we want to still tie that to a process estimation. We'll say 55 kilowatt hours of electricity is going to be consumed. And let's say that water use is going to be 3.8 gallons per kilogram of hydrogen. If we want to use put our process parameters in one place, and let's say waste water is going to be 1 gallon per kilogram of hydrogen. We'll specify that. Also, let's say that fixed Opex some more parameters in var Opex. Let's say for variable Opex, we have 2.5 cents per kilogram hydrogen, and in our process model, we'll have an estimate of 3% of capex. So let's populate those in the model. So for water usage, we'll say that physically we use 3.8 gallons of water. So you'll see that the units are of the header are reflective of what we just specified. So water gallons per kilogram of hydrogen. Wastewater that we generate is going to be 1 gallon per kilogram of hydrogen, and that will complete our variable feedstock, waste, and variable Opex. For cogeneration, electrolyzers typically make oxygen. For sake of example, let's say that we have a we'll just specify those. So we can say oxygen production in our process sheet. Every kilogram of hydrogen that you produce 4 kilograms of oxygen. Actually, no, that'll be 8 kilograms per oxygen. You have 16 grams per mole of oxygen for every 2 grams per of H2. So that ratio stoichiometrically would be 8 kilogram O2 per kilogram H2. So as a co-product, we have the opportunity, we physically can make oxygen. We'll say what the unit is, what the co-product might be, and we can say we're going to measure that in units of kilograms, and that's going to be equal to whatever is in our process sheet. So these two sections are physically what is being consumed or co-produced by a hub or by a project. We can now minimize those and go on to look at what is the value of feedstock or cost of the feedstock, and what is the value of any of the co-products. So in this next section, we can do one of a couple of things. For electricity, we can say, let's say that if this is a wind farm, and we can have 0.03, so this is 3 cents per kilowatt hour electricity. We can plot it to see what it looks like. Or we can also overwrite this and put some price profile. Let's just quickly demonstrate what that would look like. In the overrides tab, we'll look at where is the price of electricity. So cost of electricity is in here, and perhaps we'll go to annual energy outlook and look at the nominal profile of that feedstock. So from annual energy outlook, I have a little cheat sheet here on the sides. I can see that it starts projecting electricity from 2021. And I'm going to just paste in the electricity profile that's available from AEO. And by the way, annual energy outlook only projects up through 2050. So if you have any projection of escalation beyond 2050, you would have to do that, homework yourself. So since we put in any kind of value in this column, you'll see that now I will say that set of parameters in here is overwriting. That means that anything in the interface sheet is now being overwritten, and it doesn't matter what value you put in here. What goes into the model is going to be annual energy outlook or whatever other profile of cost you have over time. So when we plot this, or if we change our cost of electricity assumption, let's say 10 cents per kilowatt hour, it's not going to matter. the price is going to be reflective of whatever is in the overrides tab. In this case, annual energy outlook. If we want to change our minds and go back to the simple set of inputs, we would go in here, delete all the inputs, and in that case, it's not going to override anything. If you forgot any value in here, let's say you forgot to have, let's say there is a 0, it will still override it. It will assume that you have 0 for prices. So make sure that you don't have any remaining value in the overrides tab. So let's go back to our 3 cents per kilowatt hour electricity. For cost of water, average cost of water, let's say it's $3 per 1,000 gallons. You would say 3 divided by 1,000, and you need to say equals, or so that's going to be price of water. It's in terms of digits, it's pretty small value. 0.03. And that wastewater, let's say that we pay $1 per 1,000 gallons for wastewater. You would say 1,000th per gallon of water, and you can see that the wastewater, what that valuation is. Variable Opex. We use 1 unit of variable Opex per kilogram of hydrogen, and we're going to say that based off of a process estimation, variable Opex is 2.5 cents per kilogram of hydrogen. So this will let you define variable Opex, and you can go into the report tables and see that variable Opex is reflective of what you intend. So variable Opex, $20,000 per year, and then it escalates as your throughput of hydrogen increases over time, and it's adjusted for inflation at whatever rate you want to adjust it. So that's the cost portion of the feedstock, waste, variable Opex. The next section is the co-product. We only specified 1 co-product. It was oxygen. If you're just venting it and you're not doing anything special with it, you can either leave this as 0 or not specify it altogether, or you can say, well, there's a tilapia farm down the street that would like to have that oxygen to, bubble it through the fish farm, and they're willing to pay $1 per kilogram. So you would say $1 per kilogram is going to be the value, or let's say that it's something less generous than that. Let's $1 per 1,000 kilograms of oxygen, or 0.001 per kilogram of oxygen. And that will tell you, and by the way, if you see these little blue tags here, they give you the marginal impact per kilogram of primary commodity, in this case oxygen. So what this is saying, if I have, let's say, 0.1 per kilogram of oxygen, that means the impact is 80 cents per kilogram of hydrogen, is the relative impact of that parameter. So for example, you can quickly see that electricity results in $1.60 per kilogram of hydrogen. If that electricity happens to be, let's say, 6 cents per kilowatt hour, you'll see that that yields $3.30 per kilogram of hydrogen in terms of total impact. So in this case, oxygen, let's leave it at, we'll leave it something that's a little more meaningful. It will be 8 cents per kilogram of hydrogen is its normalized value of that co-product. The next section is other operating expenses. If since the default example happened to be a retail level operation, it accounts for things like credit card fees, central electrolyzer. Credit card fees are not, it's probably not going to be end retail operation, so sales taxes and credit card fees are likely not going to be relevant. There's not going to be a road tax. If you're selling a fuel, you might want to consider road tax, for example. There's an entry for that. If it's a operation that has staffing, if you have operators, you would put in how many labor hours per year. Let's say that we have 10 operators and each operator is 2,000 hours per year. You would say, 20,000 hours. You'll see depending on what wages, escalation of wages, and these are fully loaded, intended to be fully loaded with overhead. You can see the impact. In this case, labor happens to be 11 cents per kilogram is the impact on the price. Licensing and permitting, you have escalation rate for that. Rent of land, if there is no land ownership and there is a leasing that is how you site the equipment, you can specify that in here. Property tax and insurance can be specified here. They're typically proportional to the capex that is cited. Then you have things like administrative expenses, percentage of sales is the mechanism that we're using. Any fixed operating expenses, this might be anything that no matter what is going to be a constant value over time. You would specify that. Let's say that you have some other fixed Opex. You would say that, and let's say that it happens to be $1 million per year, or $3 million per year. Maybe it's maybe it's O&M, general O&M. You would specify that in here. If it's maintenance that is annualized, you can specify it in here. Or if you have maintenance items that are scheduled, a little sidetrack here. Let's say that the electrolyzer requires refurbishments every 5 years. You would say we start operation in year 4, and then every 5 years you have 30% of capex is expended. You would specify that in here, and maybe future stacks have longer lifetime, and maybe they require 10%, 20% of capex. They become cheaper over time. Whatever you would like to have there, you can also design those in. So, for example, here, if we look at capital expenditure for electrolyzer, if we provide in refurbishments, you'll see that you have initial capital expenditure, and then we provided certain refurbishment or capital expenditure that happens over time. One note for this, any refurbishments for maintenance or what have you that are specified in this manner are capitalized, meaning that they're financed first with any cash on hand that's available from normal operating expenses. And then if that doesn't cover the refurbishment, capital will be drawn out as debt and equity at the ratio that is specified in order to finance those expenses. They're also, in terms of depreciation, they would be also depreciated out. So if you have any major refurbishments, you can see those in terms of, so you'll see those as depreciation schedule that impacts every time you have an item that is capitalized, that is expended. So in any case, let's take those out of here, or we could also leave them, but let's just take them out for the moment. So this section for fixed operating expenses, you can define up to looks like 6 different operating expenses. You can rename them any way you like. If you have a maintenance contract that stays flat, you can say it doesn't increase over time. So that value stays constant on a nominal dollar basis, or if you want to, you can say equals inflation, and that will make it inflation adjusted fixed operating expense. Let's say we have maintenance and we want to tie it to CapEx. What we can do is equal to process estimation. Fixed operating expense is equal to 3% of CapEx. So in this case, 3% of 80 million is 2.8 million per year. So that's the other operating expenses and fixed operating expenses section. Lastly, in terms of input, we have the financial section. In here, you'll specify things like tax rate. This is tax rate that will be used for the income statement. You can look at either historical tax rate that is used by your company, or provides whatever makes sense here for you. There are capital gains tax. This is applied on undepreciated assets, and also if you have recovery of any undepreciated value, if you choose to not write off, let's say that you have a refurbishment period and you have assets that are not fully depreciated by the time the analysis period comes to close. This tax rate is going to impact residual value, or a value of undepreciated asset minus the cost basis for that undepreciable asset. There's also some Boolean selectors. So for example, if you want installation cost, would that be depreciable? So if you have any land improvements that might not be considered depreciable, you might choose to say that is depreciable and non-depreciable. Also, if there are operating incentives, you can choose to say, are those taxable or non-taxable? Capital, and again, all the definitions, you can click and read them for yourself. This capital incentive depreciable, residual value, is it going to be written off, or is it going to be, are you going to be able to realize the residual value of that asset? So for example, if you have compressors asset that are that can be sold at the end, you can choose to either write it off or not. This one here is very important. Tax losses, if they're monetized or not. We have 2 different levels of 2 different treatments of tax losses that are generated. So for example, if you have accelerated depreciation, but you're sole proprietor for an operation, and you don't have a way of monetizing tax losses by offsetting tax liabilities elsewhere in a business, if you say no, what this is going to do is it's going to spread out that the tax losses. It's going to accumulate them up to 7 years. Is at least the again, check with your CPAs what's actually going to be allowable for you, but you can treat that as a tax loss carry forward is the technical term. And right now we have programmed it up to 7 years, but if you have different provisions, you can type in 15 years, and basically any tax losses that are generated can be carried forward up to X amount of time. This is also very relevant provision if you have tax credits, being a being an incentive. If you have a tax credit but you don't have tax liabilities, that tax credit can offset. That could potentially go into a tax loss carry forward, typically of 7 years. And again, I encourage you to look at the report tables. If tax loss carry forward is used, you'll see additional rows are going to populate where it's going to explicitly show you where the tax losses are generated, and also how they're incurred as your let's say accelerated depreciation window comes to a close. Then you can see what tax losses are accumulated, and you can offset future tax loss liabilities. Generally, quite a bit better to have a tax equity investor, a large, a corporation, partial interest, full interest of the on the equity side, in order to be able to realize accelerated depreciation tax losses as well as any tax credits that are made available. So if you notice, right now we have $3.36. If you're not able to realize monetized tax losses, or we can say, yes, we can offset tax liabilities elsewhere in our business and really be able to monetize that tax loss. Now we can charge less per kilogram of hydrogen. So this parameter here, very important to be understood, and to have the equity structure that can actually take advantage of tax losses and tax credits. Depreciation method. This is a global depreciation method. It can be overridden. So, for example, if you say makers of 20 years in the capital structure, that's going to be just the default method that is being provided. You can override it here and do straight line depreciation for one capital item, or you can just use the default that was specified down below. So this input here is just a convenient way to populate the same depreciation method for a bunch of things. But in terms of supersedence, anything that is specified here, this is what the model will actually use. If you don't specify anything, it will just use the values that are specified down here. Discount rate. This is the equity, if you will, return on equity that you would like to achieve. In this case, we specified 10%, and in order to achieve 10%, we need to sell the hydrogen for $3.15. This is not project level project level rate of return. This is the equity side rate of return. The project level rate of return in this case is 21%. But once you account all the cost of financing, etc., and you roll it up to the equity sides, and it's a leveraged performance, then the equity would yield 10%. If you would like any other rate of return, let's say that you have more of a municipal or utility type of rate of return, you can say 5% here, and that price of hydrogen is going to be computed in order to achieve NPV equals 0 and nominal rate of return. Nominal rate of return on equity is going to be, in this case, 5% or whatever you specify here. If it's a high risk investment and the equity side needs to balance out that risk, you would have, you might specify something higher and look at what price is required to account for that higher equity risk. Debt to equity financing, we have it as input is a debt to equity financing. If you're uncertain what that means in terms of if you're more used to seeing what percentage of financing is from debt and what percentage of financing is from equity, that is displayed here on the side. So if you say debt to equity is 1, it means that the debt is 50%, the equity is 50%, and the debt to equity is 1. If you want to say 2, that means that 67% of the financing comes for debt, 33% comes from equity, and the ratio of debt to equity is 2. I'll leave that as a 1.5 at the moment. In terms of debt, we have 2 different types. One is one-time loan. If you want to see the principal of the investment decrease over time, you would specify one-time loan. Obviously, this is a less leveraged capital structure, and as such, the cost that you have, the cost you have to recover per kilogram of hydrogen is higher. So in this case, you need $4.50 per kilogram to achieve the financial performance with a less leveraged capital. Or you can say, I'm going to have a bond debt, in which case the principal stays outstanding until the end of the project operation window. And you'll see that this is a much more leveraged financial arrangement, and you can charge less. Now it's $3.39 per kilogram of hydrogen. One thing to point out, if you use bond debt or constant outstanding debt, the principal is going to be due at the end of the analysis period. If you're keeping track of obligations, such as paying back the principal, you would want to look at retained earnings and make sure that you have sufficient retained earnings at the end of the project to pay for the principal of that bond. So in terms of one-time loan, you can change the term of the loan. In this case, it's 15 years. If you want to, you can have it 30 years, etc. One thing to point out is that the loan and the debt, we're keeping the completely standard. So during the construction period, you will incur explicit interest for that debt. So if you're keeping track of cost of construction, make sure to not double count and have debt incurred during construction be specified into your construction cost, but rather just leave that out, and the model would explicitly compute construction incurred, interest incurred during construction. This is the interest rate. We use constant interest rate throughout time. So that's the mechanics that we're using. Working capital. This is the liquidity that is reserved. There are a couple of ways of looking at this. One is just for operations. You might want to have sufficient cash on hand to pay for wages and operating expenses, and you might want to have at least 1 month's worth of cash on hand. However, depending on your terms of debt terms, a bank might require you to have more liquidity on hand in order to be able to absorb bumps in the road. And more typical reserve might be 12 months worth of operating expenses. So in that case, you want to have 1,200% of monthly expenses, and which is probably more typical than having just enough liquidity for 1 month of operation. This lets you absorb fluctuations in demand, fluctuations in expenses, and things like that. So that this is generally a wiser or more common level of reserve requirements. Now let's look at providing some different scenarios. Let's say that we want to have scenarios where let's say we have different incentive levels. We'll We'll scroll down to the incentive section. This is the incentive section, and let's say we want to test examples where we'll have different level of tax credit per kilogram. So production tax credit, and we'll say that in one example we'll use grid electricity and we'll not be able to. We can operate around the clock, but our cost of electricity is going to be more expensive, and we'll not have a tax incentive. So the two parameters we're going to look at is tax credit that may become available, and actually three parameters. Another parameter is going to be a capacity factor, and lastly, cost of electricity. We'll say that our cost of electricity is going to be subject to, how we source our electricity. So we have one example. We'll say grid operation, grid operation, and a second example. We'll say we have two. We'll use two examples, but we'll. In the second example, we will say synchronous PPA. So basically, whenever the wind blows, we'll say that we have a PPA with a wind electricity producer, and synchronously, we're going to use electricity only when the wind is blowing. Long-term utilization, that was one of the parameters. You'll see it's highlighted. Long-term utilization, we'll say that if you're operating on the grid, you're only going to shut down the electrolyzer for service maintenance periods or things like that, and you might be at 97% capacity factor. However, if you're operating synchronously with a wind provider, you have a capacity factor of 47%. 47%. It's a good quality wind resource, and you're able to get 47% capacity factor. If you use grid electricity, you might not be able to qualify for a tax credit, but if you're able to do synchronous operation, you might be able to get up to $3 of tax credit. Lastly, if you're purchasing electricity from the grid, let's say that nominally it might cost you, let's say 5 cents per kilowatt hour of electricity, and if you're using wind PPA, it might be 3 cents per kilowatt hour. Okay, and all the other parameters are going to stay the same. You're going to have the same taxation. You're going to same fixed operating expenses. Anything that's not highlighted in green here is going to remain the same, regardless of which operating scenario you've chosen. So now, if we select scenario 1, we'll see that hydrogen, you can sell it for $4.37. Electricity happens to be $2.75 per kilogram. And you'll see all the other cash flows, how they're normalized. You'll see your oxygen sales are worth 8 cents, and cash on hand recovery that is also reflected as you get your operating reserve recovered at the end of the project. You'll see positive cash flows, also negative cash flows, be that operating expenses or financing cash flows. They're all going to be displayed here. One thing to note is your CapEx contribution. So electrolyzer in this case happens to be worth, the CapEx is worth 18 cents per kilogram. But if we go to our second scenario, we'll notice that we have the price point is much lower. Our capital utilization is much less. So our electrolyzer used to be worth 18 cents. Now the capital utilization is going to be lower. And that contribution, it's a fixed contribution. It ends up being 38 cents per kilogram instead of previously it was, I think it was 18 cents. So electrolyzer, your fixed operating expenses and capital expenditures, that is magnified by reducing the capacity factor of operation of this particular electrolyzer. However, because you're able to use synchronous electricity, it doesn't require assets on the grid to give you around-the-clock operation. You're not incurring things like demand charges. That becomes actually a lower operating expense in terms of what you're paying for electricity. With the wind, you have $1.65 versus with grid it's $2.75. This contribution ends up being for variable operating expenses for electricity becomes more important parameter than your fixed operating expense contribution. That's how you use the scenario analysis. Now let's say that you want to look at more nuanced treatment of the electrolyzer. Let's say that you want to model the electrolyzer degradation over time, as well as any restacking. And an analog for other systems, this might be if you have a power plant, maybe efficiency goes down over time. You might be generating more waste heat. Maybe you're incurring higher variable operating expense in terms of fuel consumption. How would you account for something that is significant enough to want to model in detail? So in this particular example, we'll go in the overrides. One thing that we specified is that we have 55 kilowatt hour per kilogram. That might be the life average consumption of electricity, so beginning of life to end of life of the stack. But if we want to get better nuance for that, we'll say that you might have 50 kilowatt hours per kilogram for year one, and let's say that. Okay, so there is I have an error catching here that is not relevant actually. If you run into any bugs, please do notify me. My contact information is in the description tab, and also where you download. You can just email me, and I'll add items to be fixed over time. In this case, this happens to not be it's not a critical bug. You can still put in information here as we would like. And in this case, we have 50 kilowatt hours per kilogram being consumed in the first year, and we'll simulate every subsequent year degradation or increase in fuel consumption per kilogram. We'll say that let's say that we lose 2% performance per year, or we increase the fuel consumption up to a certain level, and then when it becomes economically desirable, we can say, well, we'll refurbish, and in year 12 we'll incur, let's say, 20% of initial capex, and we return back to baseline performance. So this way, if we copy this formula down, we'll see that our electricity consumption goes up and down, and every time we refurbish, we expend 20% of capex to get back to that beginning of life performance. So when we look at the interface and we look at feedstock, we'll see first thing, it's being overwritten. So this feedstock consumption is no longer being read from here, but rather is being overridden. And you'll see that the feedstock consumption, there's the ramp-up period, but then the expense follows a seesaw pattern that's commensurate to the degradation schedule. And the same thing can be done in terms of, if you're producing waste heat, for example, if you're keeping track of steam generation from certain type of equipment, and that's a material quantity to keep track of, you can increase the amount of waste heat that's generated and increase the amount of feedstock that is being consumed. You also see that play into the cost of goods sold chart here. You'll notice that two things happen over time. We have the refurbishments incurs additional depreciation expense, as well as, it's really hard to tell from here, but your fixed operating expenses or variable operating expenses for fuel do reflect that degradation over time. And also you'll see the price point, levelized price point is covered as well. You have a version that shows ammonia production. I'm going to show you how the example is set up. Just as the electrolysis case study that we just went through, the analysis has a TEA parameters, techno-economic analysis parameters, that are grouped together for convenience purposes and for organizational purposes. We can see that in this example, we take wind electricity, which is balanced out on a net basis with the utility grid. So when the electrolyzer doesn't have enough electricity to operate from wind electrons that are being generated on a synchronous basis, it is allowed to purchase electrons from the grid, as well as when there are excess electrons generated by the wind turbine and the electrolyzer cannot take those electrons, they are also sold to the grid. The process flow for this system has electrolysis production. It has air separation to produce nitrogen molecules, and then you compress the nitrogen molecules. You have a compressor that feeds into a Haber-Bosch ammonia synthesis process. And lastly, there is ammonia storage. We don't really model the final use of ammonia. We do show a distribution and transmission portion of the supply chain, but basically the ammonia is agnostic whether it's being used for fertilizer or fuel or for metals production. The model is agnostic as far as its final use. So in terms of our TEA portion of the example, we have ammonia nameplate capacity. It's able to produce 300,000 kilograms ammonia per day, or 300 metric tons of ammonia per day. Of that, 50,000 kilograms of hydrogen needs to be produced via electrolysis. Nitrogen is produced for the remainder of the mass to produce the ammonia, so 247 tons per day. The model assumes desalination. This is again roughly mostly feeding the hydrogen production portion of the plant. We have offshore wind capacity to power the electrolyzer and to have the required amount of energy for hydrogen production, and also to provide energy for compression and other things like keeping ammonia at cryogenic temperatures and its storage temperature. And lastly, for example purposes, we have oxygen co-production. Oxygen is produced by the electrolyzer, and obviously oxygen can be produced by the air separation unit. Since this example uses offshore wind, presumably that oxygen could have value for fish farming, for putting that oxygen into the water for increasing the oxygen content for fish. So that's the example we're going to use for a demonstrating a co-product. In terms of system capacity, we spell out the capacity of each of the units in order to estimate the capex. This is going to be an input for the H2FAST analysis. We also estimate we have a power run-up in order to figure out how much of a wind farm is necessary to provide the right amount of energy. We have a capacity factor that only really limits the wind production and informs the amount of electrons that are going to be produced from a capex expenditure and fixed operating expenses that are associated with the wind farm. The wind farm happens to be about 300 megawatts. Electrolyzer is 50. Electrolyzer is 120 megawatts, and then the remainder of the electrical draw for this example is fairly minor. This is our total fixed Opex, and then you have other parameters that you can review at your own leisure. In case anybody's interested, I've kept track of the references that we use to inform the capital numbers and the other techno-economic parameters for this case. So if we look at the interface tab, we'll notice that the first section is fairly different from other hydrogen production. Instead of having hydrogen as being the primary commodity, we can see that ammonia is being provided as a primary commodity. Depending on different types of hubs or different projects, this can be changed to whatever is necessary to suit your application, as well as the units of the primary commodity. We've identified it as tons, and also the capacity it's tons per day. So this is the time unit of the capacity. We have the capacity is 300 tons per day, which points to the techno-economic parameters tab. In terms of sales specification, we're modeling this as a price setter model. So we use the cost that the model computes that covers all the operating expenses and cost of capital in order to achieve 10% discount rate or rate of return on equity in this example. With this cost, we also achieve project level IRR of 16.3%. The project is aligned for a 40-year operation. It has a 3-year construction period, and the ammonia synthesis is run at 90% of capacity factor. In terms of incentives, we have 4 different simulated scenarios, and I'm going to zoom in so that you can see those better. We've simulated example without any incentive. We've simulated an example with a production tax credit, an example with a capital incentive only, and then also an example with both the capital incentive as well as production tax credit. Since this particular example doesn't strictly produce hydrogen, we had to estimate how much hydrogen was produced per ton of ammonia, and then translate that into how much incentive would be can be realized if that many kilograms of hydrogen were incentivized at a level of, I believe, $3 per kilogram. So in order to do this, we compute the amount of hydrogen that needs to be produced to produce 1 ton of ammonia. So in order to produce a ton of ammonia, we have to produce 178 kilograms of hydrogen. And if each of those 178 kilograms was incentivized that it produces a tax credit of $3, then your total incentive revenue per ton of ammonia produced is 178 times 3, or each ton would be subsidized, would yield a tax credit of $533. So when we compute the production tax credit on a per ton of ammonia basis, it's $533 per ton of ammonia. And here you can see that the different scenarios have different level of capital incentives and different level of production tax credit. And those result in different levels of price and price point for ammonia. If we cycle through the scenarios, we'll see that ammonia sales, as well as amount of tax losses that are monetized, varies between example to example based off of the amount of tax credits that are realized and amount of capital incentives that are made available. So besides those, the one thing I would like to point out is that the hub level analysis is compressed to have wind turbines, mechanical vapor compression desalination plants. Those all of the capital items are compressed into one total capex. We are able to differentiate items that can be depreciated differently. So, for example, we have wind turbines have different depreciation period than other equipment. Arguably, electrolyzer could be depreciated at a faster pace, but that's for due diligence to be needs to be made to determine what depreciation can be achieved for that. The capital is expanded on basis of roughly a third each of the 3 years of construction. This is the overall electricity consumption per ton of ammonia. Looks like we're using 4.5 megawatt hours per ton of ammonia. We have cost of electricity. Some electricity that is sold to the grid. We also have as a co-product oxygen in terms of material or energy flow. Those are the co-product quantities. We have electricity from the grid. We've assumed 5 cents per kilowatt hour and variable Opex for distribution. It was quantified as $60 per ton of ammonia. In terms of co-product value, we happen to assume that electricity sold to the grid would be valued at 3 cents per kilowatt hour. Price of oxygen, we used $10 per thousand tons, per thousand kilograms, or $10 per ton. And then you can see the fixed Opex assumption and financing specifications. So in terms of the hub level performance, you can see a breakdown of which parameters are important and which parameters are less important in terms of cash flow. And the gap analysis results are available in the report tables, and they outline income statements, cash flow statements, balance sheet, throughout the analysis periods of the hub. So this gives hopefully an idea of how to use the H2FAST model for not H2. You can specify things like ton miles of freight and then specify variable operating expense in terms of dollars per kilogram of hydrogen consumed, capex in terms of how many tractors, how many trailers, driver wages, etc. So the model is, again, very flexible to analyze a variety of circumstances.